Canada has quietly redirected nearly $5.7 billion in its tourism strategy, a shift that has flown under the radar for most Americans, yet it has major implications for travel, business, and the broader North American economy. For decades, the United States has been Canada's largest tourism partner, with millions of Americans crossing the border every year for vacations, shopping, skiing, business, and family visits. However, rising travel costs, inflation, changing consumer habits, and the lingering effects of the COVID-19 pandemic have prompted Canadian authorities and private tourism operators to rethink their approach. The $5.7 billion in investment represents a combination of government spending, private partnerships, marketing campaigns, airline route expansions, and infrastructure improvements aimed at diversifying the tourism market. Instead of depending heavily on American travelers, Canada is now reaching out more aggressively to Europe, Asia, and the Middle East, while simultaneously upgrading the quality of the experiences it offers to all visitors. This strategic rebalancing does not mean that Americans are being turned away. On the contrary, U.S. tourists remain a cornerstone of Canada's tourism economy, but the focus is shifting from sheer volume to high value, premium experiences that generate more revenue per visitor. For American travelers, this could translate into higher hotel rates, more targeted travel promotions, and a focus on luxury, ecotourism, and curated adventure experiences. Cities and regions that previously relied heavily on budget travelers may now see a transformation in the type of visitors they attract, while international markets that were previously underdeveloped are now receiving substantial attention and investment. Economically, this move is significant. Tourism supports millions of jobs across hotels, airlines, restaurants, attractions, and small businesses. A redirection of $5.7 billion can reshape local economies, create new opportunities in underdeveloped regions, and reduce vulnerability to fluctuations in one single market. Canada's strategy reflects a long-term, stability-focused vision rather than a reactionary or politically motivated move. It's about protecting revenue streams, maintaining employment, and ensuring that the tourism sector can withstand global uncertainty while still providing a top-quality experience for visitors. For the United States, this means that cross-border tourism remains strong but may look different in coming years: fewer bargain deals, more curated experiences, and a greater emphasis on premium offerings. On a global scale, this strategy illustrates a broader economic principle. Smart diversification is key for any country that relies heavily on tourism dollars. While Americans may notice changes in pricing, marketing, or travel patterns, the relationship between Canada and the U.S. remains strong, evolving in a way that benefits both economies. What's most important is that this shift is strategic, not political, and it highlights how even closely linked neighbors like the U.S. and Canada are adapting to a new global travel landscape. Ultimately, travelers on both sides of the border will continue to benefit, just in new and more sustainable ways, as Canada balances its tourism revenue, attracts international visitors, and ensures that millions of Americans can still enjoy everything from the Rockies to Toronto, Vancouver, and beyond. This is a story about money, strategy, and travel evolution, one that most people overlook, yet it quietly shapes the future of North American tourism, jobs, and cross-border experiences for years to come.